Most new investors talk stocks, but smart investors, they quietly build wealth with bonds. And Benjamin Graham, the father of value investing, had some very specific advice about how to do it right. In this video, we'll break down the bond strategies from Graham's legendary book, The Intelligent Investor. What types of bonds are safest, how taxes play a role, and what mistakes to avoid when building your portfolio. Graham believed every defensive investor should own high-grade bonds alongside stocks. Why? Because bonds provide stability and protection during market downturns. Think of bonds as the shock absorbers of your portfolio. When stocks get volatile, bonds help you sleep at night. Graham outlines four major types of bonds. Here's what you need to know about each. 1. U.S. savings bonds. Series E and H are very safe, backed by the U.S. government. Series E accrues interest over time, while Series H pays interest semi-annually. They're great for small investors and tax-deferred growth. Graham loved these for their guarantee and simplicity. 2. U.S. government bonds. Treasuries pay more than savings bonds and are fully backed by the federal government. They are subject to federal tax, but exempt from state tax. For example, Treasury bonds yielded 6 to 7% in the early 1970s. 3. Municipal bonds, state and local, provide tax-free income for those in high tax brackets. The risk depends on the issuing city or state, so choose only high-rated bonds, AAA, AA. They are ideal if your income is above $20,000 in 1972 or adjusted to today's tax brackets. For corporate bonds offer the highest yields, but also the highest risks. They must be investment grade, A, AA, AAA. Graham warns to avoid junk bonds unless you do deep research. By sacrificing quality, an investor can obtain a higher income, but also higher risks. Graham emphasized one key point: your tax bracket matters. If you're in a high tax bracket, municipal bonds may net you more after taxes. But if you're in a low bracket, stick with U.S. Treasuries or savings bonds. In 1972, Graham noted that 30% of your income could be lost to taxes unless you chose tax-free bonds wisely. Even smart investors make mistakes with bonds. Graham highlights a few key traps to avoid. 1. Falling for high-yield, low-quality bonds. The extra return isn't worth the extra risk, especially for beginners. 2. Ignoring call provisions. Bonds can be called back early, hurting your returns. For example, 5% bonds redeemed early at 106 instead of rising to 160. Investors lost big. 3. Overlooking maturity length. Short-term bonds are safer, but lower yield. Long-term bonds offer more, but expose you to interest rate risk. Balance is key, just like in stocks. Graham's bottom line? For most defensive investors, stick with high-quality government or municipal bonds. Choose shorter to medium maturities if you fear interest rate hikes. Rebalance regularly, and don't chase yield. Chase reliability. The investor's chief problem, and even his worst enemy, is likely to be himself. So if you're just starting out, or just want peace of mind, follow Graham's path. Make your bond choices smart, safe, and strategic. Like, subscribe, and share this if it helped. And drop a comment. What kind of bonds are in your portfolio? Or are you planning to add some now? Stay steady, stay safe, and stay invested.